So today, St. Louis Federal Reserve Bank President James Bullard gave a speech at a conference in London. And Reuters UK and CNBC reported on it, and he was warning people about how the global economy is slowing down. There's risk to global trade with the trade war. And I'm going to read some of his comments here because they show that the Federal Reserve is truly desperate and that the Fed really doesn't know what they're doing. And I'll cite counterexamples why. And in my opinion, and James Bullard said this, that everything now is on a month-by-month basis. It might not even be that anymore. Desperate to keep things up for just another month at this point. And, okay, so let me get into the article. St. Louis Federal Reserve Bank President James Bullard said global trade and other risks remain high for a U.S. economy that may slow down more sharply than expected. So they're warning. They know the global macro data is bad. Anyone who's paying any attention knows the global macro data is bad and getting worse. It's gotten a lot worse since 2019 started. As a result, the Fed, quote, may choose to provide additional accommodation going forward, but decisions will be made on a meeting-by-meeting basis, he said in remarks to a conference in London on Tuesday. So what happened with the Federal Reserve announcing not QE this past Friday, it wasn't even done at a Fed meeting, which means to me that this was most likely an emergency meeting. So either there was a bunch of emergency phone calls back and forth and or a secret emergency meeting. And we know that there was 2 emergency meetings since Christmas Eve of 2018. There was the one botched press release that U.S. Treasury Secretary Steve Mnuchin put out, citing like all the different government agencies, including the Fed, the Treasury, the FDIC, even the Plunge Protection Team, which actually the Federal Reserve, even the Plunge Protection Team was actually cited in the press release. I covered that. But for those of you not aware, there was actually another emergency meeting, I believe, in May, at the end of May, and TheStreet.com reported on it. I guess the reporter got the scoop. I don't know how. But so there's been 2 emergency meetings that we know of, and the reporter reported then it's on the street, and I covered this. Danielle DiMartino Booth put this tweet out back in May when this happened, that it was about the corporate bond market and the junk bond market. So what this says to me, meeting by meeting basis, that's month to month. They're not even thinking about the future, guys. They're not even thinking a year from now, 2 years from now. It's all month to month. It's all bubblegum and duct tape. And here's some examples of how that, for those of you conspiracy theorists out there that said absolutely everything is going according to plan for the Federal Reserve, you have Lael Brainerd, who wants the job as chairman or chairwoman of the Federal Reserve or U.S. Treasury Secretary. If a Democrat wins the White House, she will get one of those 2 jobs. If Hillary Clinton had won the 2016 election, she would already have those jobs. And she said at the beginning of 2019, she predicted this. She said, quote, if you go back and look at her comments, she said the Fed doesn't care if they invert the yield curve. And in fact, I believe she actually wanted an inverted yield curve. And now that the Fed has an inverted yield curve, we're not even a year after she said those remarks. We're at about 8 months, give or take. I believe she said them in February. We're now talking about people inside the Fed and people giving advice to the Fed that the Fed should intervene, do as much intervention as possible, bully the interest rates, the Fed funds rate, and through any means necessary. I've heard some people say this. Through any means necessary, uninvert the yield curve. So you have a situation where people inside the Fed are totally in disagreement with each other now. You have another one in this Fed speech where, by the way, James Bullard was warning, saying this trade war is going to go on for years. He says, quote, I'm not expecting any of this to go away in the years ahead for the U.S. versus China trade war. He said that a Pandora's box has been opened up on global trade. So basically, he thinks that globalization, that global trade is going to drastically slow down, that there's going to be trade wars, tariffs, currency wars, etc. with what he said, that it's not going to go away for years. And he also talked about how the Fed has tons of policy tools, slashing rates to 0, which a lot of people are predicting. So we're going to get more rate cuts, not as fast as Trump wants them. They're going to restart asset purchases. They're going to provide supportive policy promises. And also, and this comment was interesting too. He said about negative interest rates, or NIRP, negative interest rate policy, or NIRP, that was adopted in European Union and Japan. he said that he's not a big quote, "I'm not a fan of this policy. Negative interest rates have had mixed results where they've been tried." He added that it was not clear how either multi-trillion-dollar U.S. money markets would adapt to such a policy. So for the conspiracy theorists out there that are saying that everything is going according to plan, there is the Bernie bros, the lower level people inside the Federal Reserve, the PhD economists that, and I know PhD economists listen to this podcast and use fake names, and some of them even comment in the comment section and say nasty things about me, thinking I'm a moron. But it's fine, because you know what? You guys caused this crisis. PhD economists are a very large reason for why everything is mucked up that it is. They take no responsibility, no accountability, no one gets fired. They get their pensions. Some of them have 3 pensions. Janet Yellen, after she left the Federal Reserve, I think she had 3 or 4 pensions just by herself. Her and her husband together, who was an award-winning academic economist, I think he had another 3 or 4 pensions. So these PhD economists, they have massive amounts of student loan debt. They've studied a very, very narrow scope. They have most of them don't understand any financial history. Guys, I've had discussions with a few people, lower level people who worked at the Federal Reserve in the past, off the record. Someone actually introduced me on a Facebook friend on one of them. And the guy found out I liked gold, and the guy just started attacking me. He's like, "What's wrong with you? Why do you like gold and silver?" That's the past. Well, PhD economists are a dinosaur. It's a disaster. They deserve an enormous amount of the blame for the mess that we're in. Besides Alan Greenspan, Alan Greenspan even had a PhD in economics, right? So even though Alan Greenspan knew better, he knew Austrian school economics, he was a disciple of Ayn Rand, he should have known better. PhD economics, PhD economists, they all think and act and do the same stuff for the most part with the theories, but people inside the Fed, they're in disagreement. There's lower level people. The Fed, first of all, the Fed has way too many PhD economists. They have, I think, over 3,000 highly paid PhD economists with Cadillac health insurance. They've discounted. They have if you read Danielle DiMartino Booth's book, Fed Up, it's a good read, first of all. And she talks that the people inside the Fed, they get unbelievable perks. They get like discounted quality food. They get Cadillac health insurance plans. They get retirement plans. They get all these things. There's no accountability whatsoever. They make mistake after mistake after mistake after mistake after mistake after mistake after mistake, and some of them just Peter Principle their way to another promotion, don't get fired. Or they get, like Ben Bernanke, they get 6 or 7 figure consulting gigs after they mess things up even worse with the QE, after all the different QE programs that Ben Bernanke has done. So you have James Bullard today saying negative interest rate policy is bad, but you have these egghead PhD economists writing research report papers at the San Francisco Federal Reserve that came out, I believe, in February, saying that negative interest rates would have prevented the 2008 financial crisis. I think they said if the U.S. would have gone negative 5%, that there wouldn't have been a 2008 financial crisis. That's how stupid and crazy this is. You also have research papers from PhD economists at the IMF saying that during the next crisis, negative interest rates should be implemented globally. They make plenty of mistakes. When you have fiat currency and unlimited credit, especially the U.S., you can just paper over all your mistakes. It's like the little kid whose parents ask him to do chores and clean up after the dog or do laundry or chores like that. And the little kid hides the laundry because he doesn't want to learn how to put it in the washing machine himself. He hides the laundry instead of cleaning the clothes. And instead of cleaning up after the family pet, he just sweeps the poop under the rug. That's what the Federal Reserve gets away with, except it's on many orders of magnitude worse. And in it's stagflate and tax and lie. Your PhD in economics doesn't impress me. I know people who have PhD in economics who are successful in the private sector, and they tell me they don't really use their degree at all. I know people who have had to unlearn stuff. Robert Murphy, Daniel LaCalle, others. Daniel LaCalle is an Austrian. So if you want to read more of this speech, the Fed is clearly worried now about the inverted yield curve. They had the guy on, Campbell Harvey. He was on Bloomberg. I saw an interview with that. And oh my God, it was so bad the way they treated this guy with his inverted yield curve research. The talking heads on Bloomberg were like, "There's no official data that the U.S. is in recession." You know, just like it was constant 7 minutes. The interview was, I think, like 7 or 8 minutes maybe, but it was a constant 6 or 7 minutes of just nonstop nasty. The U.S. is the U.S. is not in recession. You don't have any proof. The inverted yield curve. There's bad historical data. All this other stuff. It's just ridiculous. Look, the Fed is definitely panic, confusion, chaos, and desperation inside the Fed. James Bullard said he echoed that the permanent repo facility will be done in 6 months. I've heard a lot sooner. It could happen as soon as the next Fed meeting. I mean, look, wasn't there over another $80 billion in repo today again? Bragging rights. So people, you want to go into over $100,000 in debt or over $200,000 in debt to brag to your friends that you have a paper degree where you have to work a job you probably hate for the rest of your life to be in debt? That's a good bragging strategy. I should have stuck to that before I dropped out of law school and MBA programs. Yeah, I agree. Sean, I was just being sarcastic. I was just kidding, buddy. No, the banks are still doing share buybacks. The banks are still doing share buybacks. But the banks do have a lot more earnings because of interest on excess reserves, IOER. And if that continues to fall, the bank's profits are going to get hurt. I can't remember where I heard it. I cited it in another podcast in the last couple weeks because I've done so many podcasts that 20% of all net profits for the banks are on interest on excess reserves. This is what, $80 billion a day in repos. This is why they want the permanent repo facility. So there's people, to summarize things quickly here, you have James Bullard, who's saying negative interest rate policy is bad. You have lower level Federal Reserve people now saying that they needed to go to negative interest rate policy. So clearly people at the Fed are arguing over this. There's a lot of confrontation here. Because I can tell you, I've read a lot of these research papers that even 3 or 4 years ago, Ben Bernanke was talking about some of this stuff, and there was a couple people after he left the Fed. No one wanted to talk about negative interest rate policy here in the United States, and things have changed a lot in the last couple of years. Now more people are starting to open up to it. So Bullard admitted that everything is on bubblegum and duct tape, that they'll cut as many rates as possible down to zero interest rate policy, probably not as quickly as Trump wants. As of now, it does not look like they're going to do 50 basis point rate cuts at once. I can't watch the debates. It's all going to be promises for free goodies, Trump bashing, and socialism. And yes, a Democrat socialist is a socialist. Oh, thank you, Tamar. I appreciate it. Yeah, just hit the like button. This is just going to be a short update. So I have the article with the talking about Duke University professor Campbell Harvey about the father of the yield curve indicator. Says that now is the time to prepare for a recession. So the yield for the 3-month Treasury has been above the 10-year since May, a condition known as an inverted yield curve that has predicted the past 7 recessions. The 10-year now is it's had a rally still. It's at 1.7710, and the dollar index has held above 98 at 98.31. Shockingly, the dollar index is held above 98, despite the Fed's announcement of not QE, QE4. On a relative basis, this means that on a relative basis, everyone is aware that the global economy is in much worse shape, at least in the short term. But really over the last, I think, end of August was when the 10-year U.S. Treasury, let me look at the chart. The 10-year U.S. Treasury was at 1.45. Yeah, it was around the end of August. And then it started to rally since. Interesting articles here about which treasuries the Fed will now buy with their balance sheet expansion coming, the $60 billion per month. I'll attach a link to the article if you want to take a look at it. And also the U.S. money supply now has started to rally from a 12-month low. A 12-year low. Interesting. There's two really good Daniel LaCalle articles that he's written in the last couple days. He has quantitative easing is back, and he wrote an article for the Mises Institute in the last couple days that the repo crisis shows the damage done by central bank policies. So I'll attach links to those in the information and description section. Daniel, I respect him greatly. He does have a PhD in economics, but he also manages money professionally. He teaches sometimes, and despite his PhD in economics, he's an Austrian school economist. Same thing with Robert Murphy. So I think what happened is that he got his PhD and then he started to realize, hey, this doesn't work. This is not going to help me manage money in the real world, and that Austrian school economics is going to help more. So he started to read and learn Austrian school economics on his own. But interesting comments from Bullard about the trade war. He expects this to go on for years. So he expects China to not agree to anything, and he thinks that the U.S.-China economic war, new Cold War, is going to proceed on for years. Probably until through Trump's second term. As of right now, it's looking like Trump's going to get a second term. There was a new article that came out today that's predicting that Trump will win easily a second term. Market Watch had it. Are you kidding? Bernie's better at raising money. Bernie Sanders is really good at raising money compared to a lot of the other candidates. Yeah, the debt, War Daddy asks how much debt for the PhD anyways. It depends how much of a scholarship or partial scholarship or that you get, or if you get like a teacher's assistant teaching position, you can maybe get some of it paid, some of it comped. But most people with a PhD are way over $100,000 in debt. Oh my god, people are discussing in the live chat comment section the Tulsi Gabbard workout video on her Twitter. Ugh. Her foreign policy is a lot better than the other Democrats. I mean, she seems to be anti-war. Elizabeth Warren is a combination of Bernie Sanders and Hillary Clinton. I believe that as a candidate, she does not have an original thought. So Bernie Sanders is bad for Wall Street, bad for the banks. Which means the banks might hold their nose and actually switch their support to Trump. If the banks, you know what I'd like to hear? I'd like to hear a banker honestly answer a question. If you had to choose between Elizabeth Warren or Bernie Sanders and Trump, who would you choose? Oh, that's a good one. 782. PhD means piled high debt. Yep. Yep. Don't go waving your PhD in economics in my face. I don't care. The track record of these PhD economists is absolutely abysmal. You don't like your powwow chili? How dare you? Oh, Tulsi is anti-regime change, not anti-war. That's an interesting distinction. She seemed to me to be anti-war, but I haven't heard a lot of her comments. I don't pay a lot of attention. The Democrat primary is a circus. Did you guys see the Project Veritas stuff? The stuff that came out with Project Veritas? I mean, CNN's trying to make sure that it's either Biden or Elizabeth Warren anyway. Oh, thank you for the super chat, love. AJ says the Fed needs more people with real-life business experience, not just academics. They've had a few of those, AJ, and normally they get run out of there. Richard Fisher voted against at least one of the QE programs, and he was hated after that. The former Dallas Federal Reserve Bank president, he was hated. I mean, even the ones with real-world experience. I was talking about the current Dallas Federal Reserve Bank president, Robert Kaplan. He worked at Goldman Sachs. He worked at Harvard. He worked in nonprofits, you know, Champagne Socialist, Limousine Liberal, nonprofits, and then he worked at Goldman Sachs. He was a director at Goldman Sachs. So, I mean, it's just, even the ones with private sector experience, it's like they worked for all these globalist companies or status quo companies. Hey, Sean, I can't answer that dirty question that you just asked. I don't want this video demonetized. I have enough problems with Google and YouTube. They've already taken my ad revenues down 30% in the last month. And I've added 100 new subscribers in the last 5 or 6 weeks because of censorship. But I will say, Sean, if the rumors are true, then AOC was only charging $20 before she was found about 6 or 7 years ago. There are rumors she had a nasty drug habit and some other things. Pebbleman says, don't save your money. You need to spend it to save the economy. Well, this is the danger of negative interest rate policy. So negative interest rate policy takes Keynesian policy of spending, paradox of thrift, and tries to take it to the extremes, try to force you not to save and to spend and spend and spend. But that's why you have Americans who are pulling money out of the bank system. There was a new article that just came out saying 1 in 5 Americans has pulled cash out of the bank system and they have cash under a mattress now. Well, I think Bullard is a dove. Yes, that is correct. Bullard is a dove. He normally wants QE. Supposedly Trump wanted him for his Fed chair. Trump wanted him ahead of Jerome Powell. Or either Trump wanted him instead of Powell, or when Trump was trying to fire Powell, after Trump did after Powell did the rate hike, the last one in December, and Trump was looking into whether he could fire the Fed chairman. I think Trump wanted to replace Jerome Powell with Bullard, and Bullard didn't want the job. He wanted to stay at the St. Louis Fed as the president there. People at the Fed hate gold, Jesse. Okay, you give me the super chat, Lev Galkin. Do I think they keep prices on gold and silver low for us to prepare for a collapse? No, not at all. The prices on gold are kept low to keep the dollar from appearing weak. That's one of the major reasons. See, it's a tightrope. It's a tightrope with the paper price manipulation for gold and silver. I've explained this many times, that they cannot knock the price down too low or they kill the supply from the primary gold and primary silver miners. So they want the miners to maintain supply levels. They don't want supply to collapse. So that it's a balancing act between keeping the paper prices low enough without crippling the miners or bankrupting all the miners. And this is why eventually they had to let prices rise, why they couldn't have capped gold at $1,000 an ounce or $1,200 an ounce. By the way, the miners were almost bankrupt at $1,200 an ounce, the gold miners. And the silver miners at 14 silver, they were, from what I was hearing and looking at with the financial statements, and from what I was hearing about how the silver miners couldn't raise capital, there was going to be bankruptcies in under 12 months if silver had stayed below 15. That was it. And you know what? Miners still can't raise that much capital, but their margins are slightly better, and their cash flow numbers are better now. So the miners are doing, some of them are doing okay, even though they need to raise capital and they can't. Their margins and cash flow are better now, as long as oil doesn't rise. Thank you for the super chat, Sean. The United Nations be bankrupted? I thought the U.S. government's on the hook for that. I thought Congress and the U.S. government have to make up any of those deficits. Because didn't the U.S. government funded the United Nations, the IMF, World Bank? All those funds were given from the American tax. The American taxpayer didn't even get to vote on that. The globalists, like Woodrow Wilson and others in Congress at that time, they just, when they were trying to set up League of Nations and then it failed, and then later on they wanted to just steal taxpayer money and purchasing power and set up these globalist organizations. Yeah, as far as I know, the U.S. taxpayer is on the hook for everything. So people holding dollars, they are going to lose their purchasing power. Same thing with the FDIC. If there's too many bank failures, the FDIC doesn't have the money. They have to go to Congress, and then Congress says, okay, and then Congress goes to the Fed, and then it's just printed. Max says Bloomberg and CNBC are insufferable. Yeah, most of their content is so biased. They're anti-recession, buy the dip in stocks, stock market's always going up. They ignore data. When they were interviewing the inverted yield curve professor, not a single one of them brought up the really bad Chicago Purchasing Managers Index numbers, PMI index, how they were really bad. And also the ISM data from the U.S., how it was the worst in 10 years. Not a single one. If they're going to be honest and ask an interview like that, they should have brought up that data. How do you donate to my channel? Great question. So you can go to my website, wallstreetformainstreet.com. I have both domain names. So you can go to either the abbreviated one or the fully spelled out one. And you can either donate monthly there through PayPal, one-time donation, or monthly, or through my Patreon. And I have over 160 Patreon account contributors now, so that's really good. Hopefully in a few more months it'll be over 200. It's a good question. American Expat says, do you see the U.S. trying to print their way out of this hole again like in 2008 or something bigger needed? Well, the problem isn't just with the U.S. I've been talking about this now for 6 months. It's what will collapse first. So if it's emerging markets collapsing first, that creates a different set of problems. If it's European banks collapsing first, that creates a different order of problems. If it's China that collapses first, different order of problems. If it's the corporate bond market or junk bonds, different problems. Do you understand? So it depends what collapses first, what causes the most problems, and then there will be a chain reaction. There will be an aftershock after that. Which economic landmine goes off, and then which mines next to it start exploding. So if, for example, if emerging markets go first, because the dollar is still strong, the trade-weighted dollar is still high, the regular dollar index is still high, and emerging markets have too much dollar-denominated debt. A lot of emerging markets have over-leveraged to China, exporting to China. They've over-leveraged producing base metals and oil and energy. And so there's at least 4 or 5 really major headwinds against emerging markets. And so if emerging markets goes first, then that means that European banks who have a lot of bad loans to emerging markets would also be in trouble. And we're not going to know what's going on behind the scenes. What fires are being put out, the emergency meetings that the Federal Reserve is having. Look, I've heard this disclosed. There's a bunch of corporations here in the United States and foreign corporations calling the White House, telling Trump that the dollar is too strong, that it's going to collapse things. There's a lot of people complaining. A lot of people complaining about the tariffs. I think I heard that there was over 2,000 corporations here in the United States that called asking for an exemption from Trump's tariffs, that called the White House. Thank you, Greg, for the super chat. Will pensions survive? Spartacus of Thracian. Unfortunately, a lot of pension funds are not run very smart. There's so much waste, fraud, corruption, and abuse in the pension fund management business, and bad investments, misallocation of capital. It depends which, here in the United States, it depends which political party is in the White House and which one is in Congress. And the Democrats, from what I've heard, the Democrats, now that they have some, they don't have 2/3 majority of Congress here in the United States because they don't have the Senate and they don't have a 2/3 majority in the House. Not yet, at least. But the Democrats are working on getting key preferential pro-union pension funds bailouts. Smaller ones, not massive, not like CalPERS or CalFERS, but smaller pension fund bailouts. So, yes, it might be selective with who gets bailouts, which pension funds do and which not. Roy says he's a Trump supporter, but Trump will do and say anything to get reelected. And he's now a full politician. Yeah, it definitely looks that way. Okay, well, I want to thank everyone for listening to the show. I will attach 2 links to 2 different news agencies, both CNBC, well, CNBC is some of its news, talking about the James Bullard speech that he gave today. I think it's interesting stuff. So the Fed is preparing, he's a St. Louis Federal Reserve Bank president, and he was offered the job as head of the Fed. And the Fed is preparing as if the trade war between the U.S. and China is going to go back and forth on an almost daily, he said in the speech, on an almost daily basis. And that this could go on for years. And then he is against negative interest rate policy, but there's other people in the Fed who want it. So there's clearly a fight. But I am 100% against negative interest rate policy. I have spoken to business people like Nolan Watson. Nolan Watson was saying that a lot of regular business people, if they go to negative interest rate policy, it's going to screw up a lot of cash flow and valuation models. So negative interest rate policy, if it does come to that, it could have an enormous amount of unintended consequences for regular businesses. And James Bullard talked about how it could basically destroy the money market, trillions of dollar money market funds. The multi-trillion-dollar U.S. money markets would have difficulty adapting. He's not sure how they would react to that, so they could screw those things up too. Tarkinas asks, isn't negative interest rates good for gold? I would think so. The gold price in euros is doing very well thanks to negative interest rate policy there. The gold price in euros is near an all-time high. So I would think negative interest rates is good for gold. However, negative interest rates is not really good for the real economy. Oh, thank you for the super chat, Tarkinas. I didn't see that one. Andrew Yang 2020, give me free stuff. Yeah, I don't think Yang's going to do anything as far as move up in the polls, but his policy, I wouldn't be surprised if Elizabeth Warren, since it is some of Andrew Yang's policies are popular, and Elizabeth Warren is a copycat literally on almost anything. I mean, if Elizabeth Warren is willing to steal a powwow chili recipe, what is she not willing to steal? Okay? So I would not be surprised if she added in the 17% value-added tax, VAT tax, or national sales tax as one of her policies, too. I mean, it's not her money. She's willing to promise taxing and printing to buy votes, to get votes, to win votes. Okay, well, that's enough for tonight. Thank you, everyone, for your time, and I will keep working on unique content. Not sure what I'm going to cover tomorrow. Tomorrow might be about the oil market. There's some interesting articles that have come out in the last couple days about the oil market. I'll talk about them probably tomorrow or in the next couple days. I also I have a really funny script written for something. It's called The Blame Game. I have a really funny, sarcastic script written. I think you guys are going to like that one. It's going to be really over the top. I have not recorded the audio yet, but I have most of the script done. I have to get my game show host voice right, Mr. Chet Chapman. Oh, we got a couple more super chats coming in before I end the live stream. Thank you, Benguin. Thank you, Dimitri. What do I make of earnings being bullish for equities this week? Yeah, I mean, the stock market hasn't dropped. If they're going to make a weaker dollar, if the Fed's going to expand the balance sheet, the stock market's probably not going to crash, despite the fact that the real global macro data is bad. The real U.S. economy data is also bad. There's a lot of real data in the U.S. economy that's bad. So earnings can be goosed. A lot of it's with share buybacks. What happens, most of you guys aren't familiar with the process because they don't like talking about this on CNBC or Bloomberg, and you're not going to hear the gold community talk about how this happens, especially the alternative media, about how they move earnings higher. So normally these large corporations that are doing share buybacks, not only do you have the chief financial, I'll tell the story really quick because I've heard it a bunch of times from a bunch of different people. Not only do you have the chief financial officer on the phone all the time with people at the ratings agencies to make sure that their credit rating is not downgraded so they can continue this BS game of share buybacks to boost earnings higher. But you also have the upper C-suite executives at these large publicly traded companies. They're harassing the Wall Street investment bank analysts that are covering their stock to lower the revenue targets and the earnings targets, so these companies can then beat, especially the most important one is beating earnings. So if they beat earnings by at least a penny, the stupid high-frequency trading algorithms will move up the stock. So this is a game that these large corporations play, and this is how these large executives get rich in a short amount of time. It's very short-sighted. It's extremely myopic. Unfortunately, the compensation packages are screwed up. So a lot of these, instead of getting rich quick, a lot of these corporate executives should actually be going to jail, because long-term they've loaded the company balance sheet with debt, and then that's when you get into problems like Kodak, where the company is a dinosaur and they can't adapt because they've been doing share buybacks and beating by pennies every year for years. Sandstorm Gold doesn't use debt for buybacks. They're not loading the balance sheet with debt. If you have free cash flow, and you have free cash flow for new deals and for share buybacks because the stock is cheap, because there's a bunch of liars and shorts on Seeking Alpha lying about the company that knocked the stock price down, then you should buy the stock back because it's cheap. The amount of liars and paid shorts and bad coverage on Seeking Alpha for Sandstorm Gold is unbelievable. The worst stuff is on Seeking Alpha. At this point, the coverage on Seeking Alpha, I almost wouldn't read any of the articles. That's how bad it is. There's people on there that can't even do discounted cash flow, any of the cash flow analysis. That's how bad it is. They won't even talk about how the company has record revenues and good cash flows and how their cash flow is increasing next year. No, it's just all negative, 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 negative. Meanwhile, the company just set a record for revenues in a quarter. Company record. On pace for $100 million next year in revenues. Another record. But all the article writers are like, the stock is not cheap anymore. There's all these risks and all these dangerous things. Okay, so there's a big distinction. You're not going to hear this anywhere else. There's a big distinction between share buybacks with free cash flow, share buybacks with debt. Where a company gets in trouble is where they keep doing share buybacks with debt. And then they load the balance sheet with debt, and then they can't adapt the business. And that's how Kodak became a dinosaur. You know, Kodak actually invented the digital camera. They just refused to switch to it because they thought that they had a moat. They thought that they had a protected business with their film rolls and development and photos, that people would always want photos printed out. They thought that it was a permanent protected moat. So management didn't want to do any drastic changes. They bet that they had a moat. They loaded the balance sheet with debt. And then that's how Kodak became a dinosaur. And we all know what happened to dinosaurs. Oh, the crypto bandwagon, Kodak crypto bandwagon stuff was a joke. That's desperation. Kodak invented the digital camera. They took it to, from what I've heard, they took it to the CEO managers and said, that'll hurt our film business. Forget it. Okay, well, that's it for now. Thank you, everyone.